Hello and welcome to our virtual classroom for week 8. So as you can see, I am in our classroom and we are continuing to complete the accounting cycle. And this week we have pretty much our discussion, as we do most weeks, with the initial post that is due on Wednesday. Then you do have a test on chapter 4, and obviously this video will be right here under our virtual classroom task. And basically, as the video progresses, I will go ahead and just give you assignments throughout. So what I would like to go over today is basically our PowerPoint and our demonstration PowerPoint as well. And then so basically your student handout and your student summary. So let me open up my information here and hopefully get to that point here. Here we go. So let's start with the student summary to begin. It'll just take a second to open the file and we can see here. So what I did here is I've tried to create for you just a summary of the chapters. So hopefully, I know the chapters can be long and voluminous, but I've tried to create this summary. So hopefully here you'll see that the first learning objective is to prepare the financial statements, including the classified balance sheet, and we prepare those from the adjusted trial balance, right? We start with the income statement, which gives us revenues and expenses, and then we calculate the net income or loss. Then we move to the statement of owner's equity, because then we're going to move to the income statement. We're going to need the net income into the statement, and then this is going to give us our ending balance in our retained earnings, which we're going to need for the balance sheet. And then we use the worksheet to prepare financial statements, and you hopefully got a little bit of practice on that with your assignment. And then you want to explain the purpose of and journal and post-closing trial balances, right? And basically what we're doing here is post-closing trial balance. We're going to put our closing entries, which we are going to zero out our revenue accounts, zero out our expense accounts to income summary, zero out the owner's capital accounts and withdrawals as well. And your post-closing trial balance should only have your permanent accounts, which are your balance sheet accounts. Then here we have all 10 of the steps of the accounting cycle and the current ratio, which is total current assets divided by total current liabilities. So that's our overall summary for chapter 4, which is the accounting cycle. And then I pretty much just added here, same thing here, so you can see all of the information, and hopefully you can go through this, and as you're reading the chapter, add this information as you need in this page here. So let's move to our PowerPoint here. And it should just take a minute to load. And so I believe we covered some of these. Let me see. I don't know. I don't think we did. All right. So let's come here and make this a bit bigger, hopefully. And then you can see our income statement here. So these are the same learning objectives that came from your summary that we just did, right? We want to prepare the financial statements, which is going to include a classified balance sheet where we're classifying assets as current and long-term, and we're classifying liabilities as current and long-term. And we're going to talk about the worksheet and how to prepare the financial statements from the worksheet, explain the purpose and journalization of post-closing entries, and prepare the post-closing trial balance, and describe the accounting cycle, all 10 steps, and using the current ratio. We're going to skip the appendix in this case. So we want to prepare the financial statements, including the classified balance sheet. And so the financial statements, we start off with the income statement. As we know, that reports revenues and expenses to get our net income, hopefully not a net loss. But we need that net income or loss to then add that to our beginning balance of our retained earnings plus hopefully net income minus net loss to get to our ending balance. And then our balance sheet shows us our assets and liabilities and stockholders' equity as of a point in time. So here, when we look at an adjusted trial balance, we see the different accounts, right? So here we see all of our balance sheet accounts. So these are all of our asset accounts up until land here. Then we see our liability accounts all the way up until notes payable here. And then we see our equity accounts with the Bright Capital and withdrawals. Then you see service revenues here and then all of our expenses. And notice that our debits always equal our expenses. So if you don't have them equaling, that means something is wrong. It doesn't mean that if they do equal, that doesn't necessarily mean that you have everything correct. You could still have misposted a balance, but obviously if they don't equal, then we're in a bit of trouble, right? So we want to make sure we find those. So the relationships among the financial statements, right? So they relate to one another. So our net income or loss is what we need, like I mentioned, to put into our statement of owner's equity. And then that ending balance of the retained earnings or owner's equity is what we need to put in the balance sheet. And so here we have our net income. And this amount goes directly here, as you can see, into our net income here in our statement of owner's equity, where we have beginning balance, right, plus the owner's contribution, plus our net income, minus the owner's withdrawal will give us our ending balance of retained earnings, which is going to go into the income statement here. And then you see we have our total assets equals our total liabilities and owner's equity. And we see here that 51,550. That is our ending balance of owner's equity that we just obtained from the statement of owner's equity. And then our net income came from our income statement. So then let's move to the classified balance sheet. And here is where you are placing each asset and each liability into a specific category, right? So assets are shown in the order of liquidity, and liquidity means how quickly they can be converted into cash. So cash is typically listed first. And then liabilities are also classified as current, which is due within 1 year, or long-term, that they're due within several years from now. Okay, and so then we want to show our assets as current and long-term. So current assets typically can be converted into cash within the 12 months or the 1 year. And the operating cycle is basically your time span where cash is paid for goods and services when we're sold to customers from whom the business collects cash. So the operating cycle is typically a month, and then we have a year. And then long-term assets, you really don't convert them into cash, and you don't really use them within a year. A lot of plant assets, property, plant, and equipment, intangible assets such as goodwill, and long-term investments such as held-to-maturity investments or bond investments could all be considered long-term assets. Then we have liabilities. So current liabilities that have to be paid within cash or with goods and services with 1 year or within the entity's operating cycle is considered a current liability. So accounts payable, salaries payable, and unearned revenues are typically the most common types of current liabilities. Long-term liabilities are those liabilities that you don't need to pay within that 1 year or within the one operating cycle. So these might be longer term, right? So, and then those would be considered long-term liabilities. Then we have owner's equity. And what owner's equity, it represents the owner's claims to the assets of the business, right? An owner's equity reflects the owner's contribution to the business. We add net income, or we subtract net losses, and we subtract the withdrawals that the owner makes. So this is the amount of assets left over after the corporation has paid for all of its liabilities. So here we have the classified balance sheet, which only includes the two asset categories, current assets and current and long-term, current assets and plant assets, and then other categories could be long-term investments and intangible assets. But you see here we have current assets of cash, accounts receivables, office supplies, and prepaid rent to get our total current assets, and then all of our other assets. We could also, these are just happen to be plant assets, which is furniture and building and land, and as you can see, there is less accumulated depreciation accounts here, which is a contra asset account, and then land is not depreciated. So then you see total assets, and then we have our current liabilities, which include several payables, right? Accounts payables, utilities payable, salaries payable, and interest payable with some unearned revenue. as our current liabilities, and our only long-term liabilities is notes payable. And then we see that our total assets equals our total liability and owner's equity here. Now we want to talk about the worksheet to prepare our financial statement. So we have sections of the worksheet, and basically we're going to look at that here. And so this is a 10-column worksheet, 2, 4, 6, 8, 10. And we often use this worksheet to help us create our unadjusted trial balance. Then we do our adjusting entries. Then we have our adjusted trial balance. And then here you see in the balance sheet all of our debits and all of our credits, right? And then so our assets, our liabilities, and our owner's equity. And then here you see our service revenues in our income statement, and then all of our expenses. And then we have our net income, right, that we would put as a debit balance here and as a credit balance to show that it's going into our retained earnings account. So this is definitely one of the nice ways of using Excel. And we could see how everything ticks and ties out. We can add, our lettering here for our adjusting entries, and we can make sure that everything ticks and ties and balances out. And so that's the wonderful use of a worksheet. So one of your first assignments for this virtual classroom is to describe the worksheet and explain if you find it useful or too confusing. Are the 10 columns too much, or is it something that you feel that you would be able to complete? So that's your first option there. Now we want to move into the purpose and the journalization of post-closing entries. So we have temporary and permanent accounts, and the closing process is pretty much where we're zeroing out all of those temporary accounts: revenues, expenses, and owner's withdrawal. Our permanent accounts are the assets, the liabilities, and our owner's equity, or owner's capital. So what we do is we provide these closing entries where we're transferring the revenues, expenses, and owner's withdrawal balance to our retained earnings or our owner's capital account. So revenues and expenses, we transfer those into the income summary account, and then the income summary account, which represents our net income or net loss, we move that over into the retained earnings account. So this is a nice diagram here to go over the closing process, right? So if we have expenses, usually have a debit balance, right? So we're typically going to close them out. Here we're going to debit the income summary and credit the expense account. Then revenues typically have a credit balance, so we're going to debit the revenue account and then credit the income summary. So typically the income summary account has the balances of the accounts, right? It would have revenues as a credit and expenses as a debit. So if revenues exceeds expenses, then we have a net income. And then that net income is added as a credit to our owner's capital account. And similarly, since owner's withdrawals have a debit, we're going to credit that and we're going to debit the owner's withdrawals into our owner's capital account to get an ending balance. And so typically we want the ending balance and owner's capital to be a credit. So this, you see a T account of how all of the transactions get moved, get debited and credited. And then here you see all of the journal entries, right? Where you're going to debit your service revenue and credit your income summary to close out the revenue account. Then you're going to debit your income summary and credit all of your expenses to close out those expenses. And then you're going to actually have your, your total revenues, right? And then your total expenses. So you're going to have a balance, and that is your net income balance in this case. So we are going to debit our income summary and then move that net income into our retained earnings or owner's equity account. And similarly, when we are going to have to credit the withdrawals to zero them out and then debit the Bright Capital to show a reduction of the $5,000 for the withdrawals. And then we basically have so now we have our owner's capital, and our income summary should always end up zero, right? And so then once we have that, then we move it out and we should be good to go. So then once you are closed all of your journal entries, you'll see them here, closing out your revenues, closing out your expenses, closing out the income summary account, and lastly, taking into consideration the withdrawals. And then here you see all of the service revenues being closed out, all of the expenses being closed out into the income summary, and then from the income summary being closed out into Bright Capital. So the next part of your assignment is, do you prefer the T accounts or do you prefer the journal entries when you're looking at closing entries? So is this view the view that you prefer, where you're seeing all of the movement of the transactions via T accounts, or do you prefer this particular depiction where it's just you're listing out all of the closing journal entries? So this is the journal entry view, and this is the T account view. So the second part of your assignment is to note which way do you prefer, T accounts or journal entries. Now let's prepare our post-closing trial balance. So basically, when the accounting cycle, the last step is to do our post-closing trial balance. And what this is a list of accounts and their balances at the end of the period after we've done our closing entries. The key that you know it's a post-closing trial balance is because there are only permanent accounts. So as you see here, we do not see any revenues. We do not see any expenses. All we see are assets, liabilities, and our final balance in owner's equity. All of our permanent accounts are listed here. Great. Now let's describe the accounting cycle. So here we have the accounting cycle where we start with our account balances, then we prepare our journal entries as we need, then we post the journal entries to the accounts that they relate to. Then we look at the unadjusted balance in each account so we can prepare an unadjusted trial balance. And then we start our worksheet process. So I like to call it the 10-column worksheet. So the first 2 columns are our unadjusted trial balance. Then we prepare journal entries. Then we have our adjusted trial balance. And from that adjusted trial balance, we create our financial statements in this order. The income statement, because we need the net income to move into the statement of owner's equity. And then we need that ending balance of owner's equity to go right here under the balance sheet. So once we prepare the financial statements, then we do our closing entries, and then we prepare our post-closing trial balance. So another one of your assignments is, of the 3 financial statements listed here, which do you find to be most useful? Is it the income statement, the statement of owner's equity, or the balance sheet? There is also a 4th statement, the statement of cash flows, that you can mention as well. In this case, we're just preparing the income statement, the statement of owner's equity, and the balance sheet. So of these 3 statements, this other part of your assignment is to make sure that you say which of these do you find most useful. Now let's talk about the current ratio to evaluate business performance. So the current ratio is your total current assets divided by your total current liabilities. And what this ratio does is it measures the company's abilities to pay its current liabilities with its current assets. So, and if it has a 1, then that means anything greater than a 1 we like, because that means we have more than enough assets, current assets, to pay for our current liabilities. And then the last learning objective here is reversing entries, right? So reversing entries, they're not really required by GAAP, but in industry, we do these. And basically, for example, if you are, you're right here, you're accounting for accrued expenses, right? And so you're going to put salaries expense of $1,200 and then salaries payable of $1,200. And so we're doing that as of December 31st to show that these expenses are incurred, and we want to produce this journal entry. So then what happens is if we don't reverse it, right, then we have to debit our salaries payable and then debit our salaries expense and then hit cash for $2,400 to show that, we have 2 payroll cycles, right? But if we do have a reversing entry, what happens is you just do the exact opposite, right? So since we are debiting salaries expense, we're going to credit it here. And since we are crediting salaries payable, we're going to debit it here. So you're literally just doing the opposite. But then when you do that, you can record your salaries expense of $2,400 on January 15th because you've already had accrued the $1,200 in December, and now you have your other $1,200. So it kind of nets out. And that's pretty much what we're doing here with these. So I always use reversing entries as a CFO because it was just a lot easier to keep track with. If I accrued it in December, then I can put the salary expense here because then I have the $1,200 coming in January, as you can see here on January 1st, to offset it. So then I did record $1,200 in December and then $1,200 in January like I needed to. So that is an overview of our accounting cycle and our chapter 4 here. And basically, that's what's in here. So make sure that when I post this video here, you'll see it, and then hopefully you'll be able to answer the questions that I put throughout this video now. So the last order of business that I want to do is I want to show you the demonstration problems. And basically what I tried to do is select for your assignment problems that relate to this particular problem, right? So if you see here, let me put this in slideshow mode. And then so when you do that, and as you go through it, you'll see the problem, you'll see your unadjusted trial balance here, and then your adjustment data that you need. And basically it tells you what to do, and then it walks you step by step for each of these items. So here's your first requirement where you're adding all of your balances in to each of the accounts. And then here's your second requirement, which you're filling in your worksheet that you have your unadjusted trial balance, your adjustments, and then your adjusted trial balance. And note that all of the amounts tie in. All the debits equal the credits, so we know we're doing those right. Then we're going to produce our income statement, which is revenues minus expense, to get our net income. And then we're going to add that net income to our credit side of our balance sheet to get our total assets equals our total liabilities plus owner's equity. And then you're going to look at each of the adjustments for each of the, so if prepaid rent is out there, office supplies that were used, depreciation that needs to be recorded, and you need to adjust your salary similar to what we did in the reversing entries. And then it gives you the adjusted trial balance, and then we go ahead and produce the income statement, revenues minus expenses, to get to our net income. And you'll see that, and you'll see your total net income there. And we need that amount to add to our $28,000 beginning balance, our net income for the year. There's no additional owner contributions here, but there is a $3,500 owner withdrawal to get our ending balance in our owner's equity that we need to add to the balance sheet. And so here we have all of our current asset accounts, then our plant assets, to get our total assets, and then we have our total liabilities, our current liabilities, which equals our total liabilities. We don't have any long-term liabilities in this instance. And then we add our owner's equity to get our total liabilities and owner's equity to match our assets. So as you go through each of these, then you see how we're going to prepare our closing entry. So we're closing out revenue to income summary. Then we're going to close out all of our expenses to income summary. And we see all of the T accounts here, and all of our temporary accounts here are 0. And then we want to take our income summary and close that out into our capital account to show our net income there, that we're moving it and adding it to our owner's capital. And then we're going to subtract our owner withdrawals to make sure that we adjust our capital account and make sure that it balances. And then we prepare our post-closing trial balance, which we know only has assets, liability, and owner's equity accounts are permanent accounts. And then from there, we see hopefully that everything ties. Debits always equal credits, right? And then we look at our current ratio, which is our total current assets divided by our total current liabilities. And we see up here that we have our cash, as you can see here, of $16,750, our accounts receivable, our prepaid rent, and our office supplies that are total current assets. Equipment is our plant asset or our long-term asset, so we don't include it. And then for our liability accounts, we know that the accumulated depreciation of the equipment, that's a contra asset account, and it goes with equipment, so it's long-term. So we start with our accounts payable as our first current liability, our salaries payable, and then our unearned revenue as well. So once we do that, you'll see all of those here like we did. So see, you see the 6,600 for AP, the salaries payable 230, and we have 3,300 of unearned revenue. So that gives us a 3.5 roughly as our current ratio. So that means we have 3.5 times our current assets to pay our current liabilities. So the higher this ratio, the better. So the last part of your assignment for this week of virtual classroom is to describe the current ratio. So you have the formula here, but describe why an organization would want to make this ratio as high as possible. And typically, because then you have a lot of assets, which is typically cash, to pay your liabilities, which are usually your payables. Perfect. So I think we've covered all of the areas that I wanted to cover for today. So make sure that this video will be right here in the virtual classroom, and I've given you questions throughout the videos, but since it usually takes us 2 weeks to cover a chapter, and I would always recommend that you go back and obviously do your readings, but here's, always look at your PowerPoints. These are your student note handouts. I give you a summary of all of the learning objectives for the PowerPoint. And then if you click on these videos here, they should open. And this one's only 2 minutes and 11 seconds, as you can see, but it really shows you an introduction to financial statements.
For an entity. We're going to look at the financial statements of a merchandising company. What is the content and purpose of the following statements? Income statement. Statement of owner's equity. Balance sheet. Statement of cash flows. The income statement presents a summary of all the revenues and expenses for an entity during a specific time period.
This is also known as a classified income statement, right? Because so it's not a simple one where we're just taking all the revenues minus all of the expenses. In this case, what we're doing is we're taking revenues minus cost of goods sold to get us gross profit, and we're subtracting selling, general, and admin expenses to get us operating income. So in the last part of your assignment, I know I said that twice now, but make sure that you differentiate a classified income statement with a classified balance sheet. So typically the income statements that you've seen before are simple income statements where we list revenues and then all of the expenses. This one we're classifying into different categories.
The purpose of the income statement is to show owners, managers, and creditors whether the company was profitable during the period shown. Since the income statement captures transactions throughout a period of time, it is similar to using a video camera to capture a live action event. Statement of owner's equity presents the increases and decreases to owner's equity. The increases noted on the statement are investments made during the period and the profits reported on the income statement. The decreases include the dividends for a corporation or withdrawals for the sole proprietor and losses which would have been reported on the income statement. The ending balance of owner's equity is then carried forward to the balance sheet. The balance sheet presents the assets, liabilities, and owner's equity of an entity at a specific point in time. The balance sheet is like a snapshot, since it reflects the entity's results as of a specific date. The balance sheet is also called the statement of financial position and is often used to judge the entity's financial health and well-being, such as the ability of the company to meet its short-term financial obligations. The statement of cash flows shows the cash coming in, cash receipts, and the cash going out, cash payments, from the business activities, including operating, investing, and financing activities during a period of time.
Let's just go back 1 second here. So here you see operating, investing, and financing activities. And so those are the 3 sections of the statement of cash flows. And I know earlier on in this video, I mentioned that. And then here you see we start with net income. So this is prepared using an indirect method. So the statement of cash flows, you can prepare it using the direct method or the indirect method. The indirect method, as you see here, starts with your net income, and then you add any non-cash items like depreciation or deferred taxes or changes in working capital. So just wanted to bring that to your attention.
Financing activities during a period of time. This visual provides the sequence of the flow of the statements beginning with the income statement. Net income flows to the statement of owner's equity. The ending equity balance flows to the balance sheet. And the ending balance of cash on the balance sheet is supported by the statement of cash flows.
And then if we go back into our module 7 here, we just looked at the introduction to the financial statements, and the last video that we have here is your closing entries. So I think you have everything you need to complete your virtual classroom task for this week, week 8. And I will post this video there as soon as it's available, and make sure that you, as you watch this video, you complete the items, the assignments and the prompts throughout. Thanks for watching.